Okay, so here we are. Left-hand side is your company. Okay. Right-hand side is your personal pocket. Okay.
Got it.
So in Canada, when you take money out of your company, what are the two ways? I'm going to let you you can be my client. Okay. And this is how I would talk to a business owner.
Okay.
When you're taking money out of your corporation, okay?
Yep.
There's only two ways to do it that everyone knows of. And what are they?
Salary or dividends.
Okay, salary or dividends.
Yes, sir.
The challenge, though, is that before you get the money into your personal pocket, there's a little roadblock in place. And that roadblock is called the CRA. Now, I'm old school. I sometimes interchange this with Revenue Canada, but we'll call it the CRA. Okay? So when the money hits this roadblock, for all intents and purposes, they take 50% and 50% is left to you. Okay? This is the way life works. Okay? Now, what does everyone want to have happen? What everyone wants to have happen is, well, I'm paying my corporate taxes over here. I want to be able to take all my money out because I already paid taxes, and I want to be able to keep my money and transfer it to my personal pocket. That's what everyone wants to happen. Unfortunately, we got Revenue Canada in the middle there as the roadblock, so this can't happen. Well, there's actually a kind of I'm just going to refer to as a workaround. And this is how it works. So here you've got, again, your company. And you've got Revenue Canada sitting here as a roadblock. Well, what we're going to do now is we're going to introduce another roadblock, and we're going to place that in front of the CRA. And for right now, just for all intents and purposes, I'm just going to call this a financial instrument.
Okay.
So you've got your corporation, you've got a roadblock, a financial instrument. That roadblock is supposed to be for revenue in front of Revenue Canada, and you got Revenue Canada as a roadblock before your personal pocket. Okay, it's fairly straightforward. So what's going to happen, or how we're going to get around this, is twofold. One, there's money that's going to be transferred from your corporation into this financial instrument. You're also going to be making deposits personally into this financial instrument. So this financial instrument is going to be shared ownership between you, the shareholder of the business, as well as the business. And there's going to be a co-pay into this particular financial instrument, both corporately and personally. Okay. Now, the kicker to this, everyone goes, okay, it sounds too good to be true. What's the catch?
Exactly. I was going to ask.
Okay. The catch is you're going to have to make deposits for a minimum of 15 years. It can be less, but you'll understand a little bit later on as I go through this why it's 15 years or plus. Okay. So as we do this, just continue on. Don't want to make it too busy. As you make deposits between year 0 and year 15, there are a couple things that can happen. Okay. Number one, you can pass away prematurely. If you pass away prematurely, what's going to happen is the financial instrument is going to pay your corporation tax-free money, either the greater of the total deposits or 25% of the face amount of the product. Okay. Now, the other thing that can possibly happen between year 0 and year 15 is you can have a health issue. You can have a heart attack, stroke, cancer, as well as about another 20 plus different health issues. Okay. If that happens, the full face amount of the financial instrument is paid tax-free into the business. Now, this money can be used if you're alive for the health issue. This money can be used to go to the States, bypass the Canadian health system. You want to go to Europe, that's fine. If you pass away prematurely, money can be used to pay capital gains, whatever else the family needs. Okay. So the reality of what some people do from a tax point of view is after year 15, what happens is you can now surrender the contract.
Hmm.
And when you surrender the contract, 100% of both the corporate and personal contributions get transferred from this financial instrument into your personal pocket, and we're bypassing the CRA.
Okay.
So this is kind of a neat way. If nothing happens in the interim and you no longer need the contract, then you can cancel it, and all the deposits that the corporation made now flows to you tax-free.
Understood. So it's basically a way to your retained earnings that you're putting in your company after 10 years, 15 years, if you're doing it properly, you can basically get them back fully tax-free. Is that correct?
Correct. So essentially, if you've got funding, like one of the challenges that I find with business owners, they think it's worthwhile keeping their money in their business because their accountant has told them to keep the money in the company.
Yeah.
You don't have to pay tax unnecessarily. But eventually what happens once all monies that are kept within the corporation, if it's not used to generate active business income, it's referred to as passive income, and that's charged or at the top tax rate of 50.2%. And once you get over the threshold of $50,000 in passive income, now you start to grind away at the small business deduction. So rather than, you think you're making 10% on a mutual fund or a stock, in reality, if it's corporately held, you're earning half of that. So rather than give your money to the government, you can now bypass that, put it into something like this, and actually reduce your overall tax situation.
Understood. Yeah, that's pretty clear. So Rick, that's what you just showed us. Is that what you refer as the napkin sale? So explaining that big, complicated context very simply?
Yeah, it's trying to share with someone an idea without actual numbers.
Yeah.
So usually at this point in my conversations, I go, would you like to see some numerical examples on how this actually works?